If you think the $10,000 bank rule works the same way it did 2 years ago, you are already behind. Because between January 2024 and right now, federal regulators have quietly rewritten the rules around that threshold 5 separate times. 5 rewrites. No press release. No news alert. No senator standing at a podium explaining what changed and why. The only people who got the memo were the compliance departments at your bank, and your bank has every reason in the world to not pass that memo along to you. This is not a warning about something that might happen. It is a description of something that already has. It has already happened to tens of thousands of Americans in the last 18 months. It has already cost some of them their savings, their closing dates, their business operating accounts, and in a handful of cases that are public record, their freedom. And the version of the rule that exists today is not just different from the one you learned about, it is structurally more dangerous, broader in scope, faster to trigger, and cheaper for the government to enforce than anything that has existed at any point in the last 55 years. In the next 20 minutes, I am going to walk you through the 5 specific changes that your bank never told you about. The exact new threshold that is now triggering reports that never triggered before. The 3 behaviors that used to be completely safe and are now federal felonies under the updated guidance. The 2 new financial platforms that got pulled into the same reporting pipeline as your checking account. And most importantly, the 5 protection moves you can put in place this week before any of this touches your money. If you have a bank account, a savings account, a Venmo, a Zelle, or a retirement account that sends distributions into a checking account, every single word of this video applies to you. Before I get into the 5 changes, I have to tell you about a couple I will call Dennis and Joan. Dennis is 73 years old. Joan is 71. They live outside of Raleigh, North Carolina. Dennis spent 31 years as a high school shop teacher. Joan ran a small alterations business out of their home for 25 years. They are not wealthy. They are careful. They paid off their house in 2019. They have a joint savings account at the same regional bank they have used since 1991. Last spring, Dennis's mother passed away. She left Dennis a beneficiary distribution from her individual retirement account, $47,000, which arrived as a single wire transfer directly into their joint savings account on a Tuesday afternoon. Dennis and Joan were expecting it. They had notarized paperwork from the estate. They had the IRA custodian's cover letter. They had a copy of the death certificate and the beneficiary designation form going back 20 years. Dennis called the bank the morning the wire was scheduled to arrive and told his branch manager exactly what was coming. The branch manager said he would note it in the file. The wire landed at 2:17 in the afternoon. By 3:45, Dennis received an automated text message telling him his account had been placed under a temporary review hold and that a branch manager would contact him within 72 hours. The $47,000 was frozen. Dennis could not touch it. He could not transfer it. He could not withdraw it. He could not use it to pay for his mother's funeral expenses, which were due that Friday. The funeral home had already told Dennis the balance of $9,400 had to be cleared by close of business Friday, or the burial would be rescheduled. Dennis spent Wednesday and Thursday on the phone with his bank's customer service line. He spoke to 6 different representatives. Not one of them could tell him why the hold had been placed. Not one of them could tell him when it would be released. Every representative told him the review was in progress and that they understood his frustration. His mother's funeral was rescheduled. His siblings had already traveled from out of state. 3 of them had to rebook flights. Dennis and Joan spent $1,100 on the rescheduling fees. When the hold was finally lifted on Friday evening, too late to help anyone, Dennis received a letter telling him a suspicious activity report had been filed on the incoming wire with the Financial Crimes Enforcement Network. That report sits in a federal database for 5 years. It will be cross-referenced against every financial transaction Dennis and Joan make for the next 60 months. Dennis had the paperwork. Dennis had called ahead. Dennis did everything right. And none of it mattered because the rule that existed when Dennis opened that account in 1991 is not the rule that exists today. To understand why Dennis got hit, you have to understand what actually changed. And to understand what changed, you have to start with the number that has not changed. Because the frozen number is the root of every problem that follows. The $10,000 bank reporting threshold was written into the Bank Secrecy Act in 1970. That year, a gallon of gas cost 36 cents. The median American home cost $23,000. $10,000 in cash in 1970 was enough to buy a brand new car and take the family on vacation and still have money left over. It represented more than a full year of wages for the average American worker. Today, adjusted for 55 years of cumulative inflation, that 1970 threshold is the equivalent of roughly $81,000. If Congress had simply indexed the rule the way they index Social Security benefits and income tax brackets, the reporting trigger would sit at $81,000 right now. You could withdraw enough money to put a down payment on a house without triggering a single federal report. Instead, the threshold has never moved, not once. Not a single dollar of adjustment in 55 years. And every American retiree's normal transactions have grown 3, 4, 5 times larger in real terms in the same period. A knee replacement out of pocket, a kitchen renovation, a grandchild's college deposit, a car purchase, a lump sum pension rollover, a life insurance payout. Every single one of those routinely crosses $10,000 today, which means the rule that was designed in 1970 to catch drug traffickers is now catching Dennis and Joan trying to bury their mother. That is the baseline. Now here is what changed on top of it. Change number 1 is what I call the senior freeze expansion, and it is the change that directly caused Dennis's 72-hour hold. In 2024, the Financial Crimes Enforcement Network issued updated guidance to every federally insured bank in the country on how they are expected to identify and prevent elder financial exploitation. That guidance, combined with updated regulations from the Consumer Financial Protection Bureau, gave banks both the authority and, in many cases, the legal requirement to delay transactions from senior accounts for up to 72 hours whenever their internal compliance software detects what the guidance calls a pattern deviation. Here is the problem with the phrase pattern deviation. It does not mean a suspicious transaction. It does not mean a transaction that looks like fraud. It means any transaction that is different from what you normally do. If you have spent the last decade depositing amounts under $5,000 and a $47,000 wire lands in your account on a Tuesday afternoon, that is a pattern deviation. The software flags it. The 72-hour clock starts. Your money does not move until a human compliance officer reviews the flag, which can take the full 72 hours or longer depending on staffing. And here is the detail that almost nobody knows. More than 39 states have now passed their own senior safe banking laws that grant banks complete legal immunity when they delay a transaction they suspect might be linked to elder exploitation. That immunity is the key. It means the bank pays no penalty if they freeze your money and turn out to be wrong. It means they pay an enormous penalty if they release money that later turns out to have been part of a fraud scheme. The economic incentive points entirely in one direction. Freeze it first. Ask questions later, sometimes much later. Change number 2 is the structuring algorithm upgrade, and this one is the most dangerous change because it carries actual federal prison time and the detection net just got 3 times wider. Under Title 31 of the United States Code, Section 5324, it is a federal felony to break your deposits or withdrawals into amounts under $10,000 for the purpose of avoiding the reporting requirement. The maximum penalty is 5 years in federal prison plus forfeiture of every dollar involved. What changed in 2024 is not the law itself. What changed is the software that enforces it. For decades, the structuring detection algorithm was calibrated to flag patterns in the $9,000 to $9,900 range, the obvious zone where someone was clearly trying to stay just under the line. In 2024, the detection threshold dropped significantly. Banks are now required to flag structuring patterns in the $7,000 to $8,500 range over rolling windows of up to 90 days. A retiree who withdraws $7,500 in week 1 and $8,000 in week 3 and $7,200 in week 5 for completely different and completely legal reasons, a car repair, a property tax payment, a medical bill, can now find all three transactions aggregated by the compliance software into a single structuring pattern flag. I want to pause here because this is the part that has already destroyed the finances of innocent Americans who never committed a crime. A grocery family on Long Island had $446,000 seized by the IRS because their deposit patterns matched the updated algorithm. They were never charged with a criminal offense. A third-generation dairy farmer in Maryland lost his entire operating account. A retired school administrator in Iowa had $31,000 frozen during a civil asset forfeiture action while she was simultaneously managing her husband's cancer treatment. None of them were criminals. All of them were caught by a pattern recognition system that does not care about your intentions. It cares about your transaction history. And with the 2024 upgrade, ordinary conservative money management, spreading withdrawals across weeks to avoid carrying large amounts of cash, now looks exactly like structuring to the algorithm. Change number 3 is the digital payment merger, and this one affects every single person who has ever used Venmo, Zelle, Cash App, or PayPal. For years, there was a clean legal separation between your bank account and your peer-to-peer payment apps. That separation is gone. Beginning in tax year 2025, every major peer-to-peer payment platform in the United States is required by the IRS to aggregate and report your incoming payments using Form 1099-K. The reporting threshold for that form has been dropping every single year. In 2023, it was $20,000. In 2024, it dropped to $5,000. In 2025, it dropped to $2,500. In 2026, it is scheduled to drop to $600. $600. That means when your grandchildren send you $700 through Venmo to cover your birthday dinner, when your neighbor Zells you $650 for the lawnmower you sold them, when your church reimburses you $600 for catering a community event, any of those payments now triggers a federal form that lands directly on your IRS tax record. And a Zelle transfer of $12,000 to a family member for a down payment now flows into the same Financial Crimes Enforcement Network database as walking $12,000 in cash into a bank branch. Same report, same database, same 5-year retention period. Most retirees who have Venmo or Zelle on their phones right now have no idea their casual family transactions are being tracked in the same federal system as suspected money laundering activity. They were never told. The apps never updated their terms of service in plain English. The IRS did not send letters. It just started counting. Change number 4 is the Form 8300 penalty explosion. And this one catches retirees sideways because it does not involve your bank at all. It involves every business you spend real money with. Form 8300 is the report any business must file with the IRS whenever they receive more than $10,000 in cash, cashier's checks, or money orders from a single customer in a single transaction or in related transactions. That covers car dealers, contractors, attorneys, real estate professionals, jewelers, and now under 2024 guidance, cryptocurrency platforms and some digital payment processors. In 2024, the penalty for filing Form 8300 late or incorrectly was raised to $290 per return. The penalty for intentional disregard was raised to $3,640 per return. Those penalties fall on the business, not on you. But here is what that means in practice for you. Every business that handles any meaningful cash payment from you now has an overwhelming legal and financial incentive to file the form accurately, on time, every time. When you pay a contractor $12,000 to repair your roof, that contractor files a form that identifies you by name, social security number, home address, and the nature of the transaction. That form goes directly to the IRS and into the same tracking database monitoring your bank account. And here is the piece that catches people. Related transactions get aggregated. If you pay the contractor $6,000 on Monday and $6,000 the following Monday for the same job, that is one $12,000 transaction in the IRS's system, and the contractor is required to file. A retiree who breaks a payment into two pieces to avoid carrying large amounts of cash has just created an aggregated Form 8300 filing on themselves without realizing it. Change number 5 is what I call the crypto capture, and it matters even if you have never owned a single dollar of cryptocurrency. Beginning in tax year 2025, every major cryptocurrency exchange in the United States is required to file Form 1099-DA with the IRS, reporting every customer transaction. Any single crypto transaction of $10,000 or more is now subject to the same Bank Secrecy Act reporting requirements that apply to physical cash at a bank. And the IRS now has the legal authority to cross-reference your crypto transaction history against your traditional banking records. If you bought Bitcoin in 2021 and sold it in 2024, the IRS already has that data. If a family member sends you $15,000 in Ethereum as part of an inheritance, that triggers the same federal report as a $15,000 cash withdrawal. The war between digital assets and traditional banking for reporting purposes is gone, completely gone. And the retiree who assumed that digital assets existed in a separate, less watched corner of the financial system is now operating under rules that treat every digital transaction with the same scrutiny as a suitcase full of cash. Those are the 5 changes. Every single one of them is in effect right now. Every single one of them affects ordinary retirees making ordinary financial decisions. Now, here is what you do about it. Because the purpose of this video is not to make you afraid of your own bank account. It is to give you the exact moves that keep your money moving without putting it in front of any of these 5 triggers. Protection move number 1 is pre-notification, and it is the highest leverage thing you can do for free this week. Before any deposit, withdrawal, or transfer of $7,000 or more, call your branch manager directly, not the customer service line, the branch manager. Explain what the transaction is, where the money is coming from, and what it is for, and ask them to add a note to your account file before the transaction happens. When the transaction hits the compliance software and generates a flag, the note is sitting right there. The 72-hour freeze almost never triggers when the note is in the file. The currency transaction report still gets filed automatically on amounts over $10,000, but your money actually moves when you need it to. Pre-notification costs you 1 phone call. Not having it cost Dennis and Joan their mother's burial date and $1,100 in rescheduling fees. Protection move number 2 is the single transaction rule. If you need to move $14,000, do not break it into 2 separate $7,000 transactions. Move it as one single $14,000 transfer. Yes, that triggers a currency transaction report. That report is invisible to you. You never see it, you never feel it. It has 0 practical effect on your life or your credit. What does have a practical effect on your life is a structuring charge, which can include federal prison time and forfeiture of the entire amount. The report is a filing. The charge is a felony. Move the money once, move it whole, and let the report file automatically. That is the safe path. Protection move number 3 is the paper trail habit, and it costs you nothing but 10 minutes and a notebook. For every financial transaction over $5,000, write down 4 things the same day it happens: the date, the amount, the source of the funds, and the reason for the transaction. A handwritten entry in a dated notebook is legally contemporaneous documentation. Almost every civil asset forfeiture case that went against an innocent retiree turned on whether they could prove, at the moment of a compliance review months later, why their transaction pattern looked the way it did. The notebook entry proves it. The compliance officer's algorithm cannot contest a dated handwritten record. Build the habit before you need it. Protection move number 4 is the designated receipt account. For any large incoming transfer, an inheritance distribution, a pension lump sum, a life insurance payout, the proceeds from selling property, open a separate account at a different financial institution before the transfer lands. A high-yield savings account at an online bank takes 15 minutes to open from a phone or computer. You need your social security number, your driver's license, and your routing number from your main bank. Once it is open, direct the large incoming transfer there instead of into your primary checking account. Your primary checking account does not get a pattern deviation flag because the large transaction never touched it. The receiving account at the online bank sees a single large incoming wire, which is normal for that type of account, and processes it without issue. Then you move what you need into checking in normal-sized amounts over the following weeks. The compliance software at your original bank never sees anything unusual. Protection move number 5 is the senior banking authorization, and this is the most advanced move in this video and the one almost nobody is using. The senior banking authorization is a written agreement between you and your bank that does 3 things. It identifies in advance the types of transactions that are consistent with your normal financial pattern. It designates a trusted contact person the bank can call before delaying any transaction. And it pre-authorizes specific categories of activity: car purchases, home repairs, family gifts, medical expenses, inheritance distributions, as pre-cleared under the bank's elder fraud review protocol. Most banks do not advertise this option. You have to ask for it specifically and request to be directed to the Senior Customer Services Department or the Wealth Management Group. The form is short. The clearance it gives you is significant. Once the authorization is in place, the compliance software reviews your transaction against your pre-authorized categories before it ever triggers the senior freeze. A transaction that would have frozen your account for 72 hours under the default process gets released the same day under the authorization. Dennis and Joan did not have this in place when the inheritance wire arrived. They do now. The last 4 transactions they have made since putting it in place, including one for $18,000, cleared the same business day without a single call from the branch manager. If you take one number away from everything in this video, take this one, $7,000. That is the new practical threshold where the updated 2024 algorithms begin scoring your transactions against the structuring pattern database. Not $10,000. Not $9,500, $7,000. Any pattern of transactions that could be read as an attempt to stay under that line is now enough to generate a flag, a review, and in some cases, a suspicious activity report that will sit in a federal database for 5 years. The $10,000 rule did not get friendlier in 2026. It got 5 layers harder, faster, broader, and cheaper to enforce. And the retiree who is still operating under the 2019 version of those rules is the one who gets frozen at the worst possible moment for the worst possible reason with the worst possible timing. You have the new rules now. You have the protection moves. The only thing left is to act on them before the next transaction you need to make. If this video showed you something your bank has never told you, share it with one person over 60 who still keeps most of their savings in a single checking account. That one share could be the thing that keeps their money moving when they need it most.